We're going to be talking about a multifamily building, a 25 unit that's been renovated. So pretty cool.
There's a million things you can do.
Yeah.
It's all about increasing revenue, dropping expenses.
This is near Wortley Village in London. For anyone who doesn't know that, I used to live in Wortley briefly, and it's kind of like that up and coming place.
And as well, what do we got to put together to sell one of these buildings? What do buyers look for? How do we pull numbers out of the spreadsheet?
We're doing it as turnkey as you can, knowing full well that real estate's never fully passive. Welcome back to REI Hot Seat. Andrew Hines here with Jacob Campanero for another remote episode, but we've got a good one today. Jake, thanks for making the time.
Yeah, good morning, Andrew. And I'm obviously in my car today, so uh,
There's a long
just
story there. We're not going to get into it.
yeah, that's all. That's all. But you know what?
Somebody
It's good.
somebody
Let's
doesn't
let's
have the
dive
keys.
into it. Listen,
Uh,
I do 90% of my business from my car, so this is nothing new for me.
yeah, there you go. All right, yeah. So cool episode today. We're going to be talking about a multifamily building, a 25 unit that's been renovated. So pretty cool. But also, this is something we just came up with, but kind of focusing on, hey, what to do when you've got numbers sent to you in a format you're not used to, some of the key things to look for, and how to quickly assess a deal, even if it's not in your preferred format. It's not in the spreadsheet you're used to using. Maybe how to look for stuff that you might want to dig in on or ask the person who provided you the numbers with about.
Yeah.
So, yeah, let's start off and just take a look at this listing. So this is just an on-market building that you had. So somebody on your team had run a pro forma on it, and they used a different spreadsheet, correct?
Yeah, yeah. So basically, this building's been on the market for some time. And I had a number of clients send it to me and say, "Hey, Jake, what do you think of this? Have you looked at this? What's your thoughts?" And I just keep getting it. And there's obviously, there's a reason why it's not selling, and there's a way that it could sell. And so that's what
Yeah.
I wanted to talk about today. And as well, what do we got to put together to sell one of these buildings? What do buyers look for? How do we pull numbers out of the spreadsheet?
Hmm.
And all that goodness. So
That's a lot to cover
that's
in
why I
a
thought,
15 to 20 minute episode. So we'll
yeah, yeah. But and that's just why I wanted to do this one today, because a team member basically, got the numbers, put it together, said, "Hey, Jake, what do you think of this?" And I said, "Oh, I've seen
yeah.
this one before," and I thought it'd be a good one just to talk about.
Yeah, okay. So let's go through what the listing is and then talk about the logic of why the owner probably did this.
Yep.
So let's see here. Okay, so starting with the listing, this is what it looks like, and I'll just jump into so 25 units. The listing realtor is saying AAA location, which I agree it is a very good location. I'll show you that
Yeah.
in a minute. Um, okay, so this is really cool. You can see the staircase. Like there's some fancy elements to this building that you would think would make it perform well. Hypothetically, would
Hmm.
perform well. I mean, the hallways are pretty standard, but it's obviously a renovated older building. And
Yeah. It's clean.
this is near Wortley Village in London. For anyone who doesn't know that, I used to live in Wortley briefly, and it's kind of like that up and coming place that people really like to live, and but it's got a lot of character and charm. So it looks like they've renovated the kitchens. Like I see quartz here. I'm assuming it's a partial renovation. Jake, we were saying that off camera. Like
Yeah.
some of
We
them
just
likely are,
again,
some of them likely aren't.
and that's it, right? So just right off the bat. So first thing is, hey, we need to understand location. We need to understand asset class. We need to understand renovations to the best of our ability. Now, obviously, the next thing would be to call the realtor and ask, but we're not going to do that on this call. So we've narrowed location. We do
Mhm.
agree, AAA. We're looking at the building. Obviously, there's been some cosmetics, some windows done.
Mhm.
The building looks nice at a 10,000 foot level. It does look
Yeah.
like the parking lot needs to be done,
Yeah, let's go look at
right?
the
So just
parking lot. Yeah, yeah, you can see it's
quickly looking
broken
at
up a bit.
that, right?
Yeah.
So that's that can be up to $100,000 plus of capex right there just to put a new parking lot in.
Hmm.
Um,
Well, you could
We'd
do the
have to find
lipstick
out.
approach to that and you just patch it and seal it. But yeah, that's not ideal at
Yeah,
this.
patch it and
Once you
seal
see
it.
it
Yeah,
crumbling in this way, that's not really the most effective solution. Like, but
and that's it. So I try to get as much as I possibly can from the photos, rather before
yeah,
driving down to the property. I don't think they have
yeah.
any aerial shots here, so we can't see the roof.
No. and you'd want to know about that too. But it looks like they have spent, at least in the units that they've turned over, they've spent some money. And we're
Yeah,
going
the
to get
units are
into that.
nice.
Yeah, and you can see the parking lot there too. Yeah, so it does look like
Yep.
that's needed. Maybe the seller didn't think that that was needed in terms of selling, but that might be one of those things that's snagging the sale. Um,
Yeah.
Another thing that I
Well,
noticed in
listen,
the numbers, and we'll get to
that's
it.
gonna come up on a that's gonna come up on a BCA, right? A building condition analysis. Like
Yeah,
it's they're gonna say, hey, your parking lot needs to be done in the next 2 years or 1 year or now, and
yeah,
here's the amount. And they're gonna come in high. So
yeah.
it's something that if I was to sell this building, maybe not go do it, but I'd definitely get a quote, right?
Right, and
Go out
you
there,
use that
find a
for
few
leverage, right?
quotes.
When you're
Exactly.
negotiating. Yeah, yeah, exactly. Okay, so just getting back to the location here. Like I know there are investors out there that just want to own in Wortley because like as far as desirability goes, like you're gonna have it. So Wortley downtown is it's got like this little strip right there. There's a restaurant that Google is suggesting to me because I've been there many times. Plant Matter Kitchen. So, anyways, I just lived on Dutchess for a little while. So anywhere in here, all old buildings, tons of character. And generally, I would think you're among the higher income earners in London. So you're going to have people who want to live there, professionals, things like that. So for those reasons, I could see it being desirable. Okay, so here's where we get into the numbers. This was presented in a format we don't normally use. But I can, it was fun working through the logic of why they laid everything out this way. And so some things off the hop that I'm going to look for, obviously, what are they selling it for? I'm going to want to know cap rates going in and what they think, what's the plan? So obviously there's a stabilization plan here, which could sort of be used like a burr, whether renovations are needed or not. We could see cash flow is negative up front, but they're suggesting that cash flow will be quite positive after whatever they're suggesting to do is. So, anything else you would want to point out on this main sheet? I guess we got price per door here. So they're saying it's 210 off the hop. I guess so. This is your internal team, not your direct, but some colleagues of yours, Jake, put this together. They figured maybe they could make an offer. There's no guarantees that that works, but they're suggesting maybe coming in around 210 a door.
Yeah, and I think right off the hop, Andrew, I look at something like this and I say, what could the potential strategy be for acquisition? When I see negative cash flow, the first thing I want to think is, okay, well, what's the debt like on the property? Is it high debt, high leverage? Is it low
Mhm.
leverage? If the latter, then perhaps we can offer something closer to the asking price with a VTB,
Yeah, seller
right?
financing
And
is
then
going
let
to be important.
that cash flow in line.
Yeah, so they had it laid out. They have a tab here for buy. And if for anyone watching, if you ever run into this, like just start clicking the cells and see which sheets they list or connect to. So this one's connected to the buy sheet for your closing costs. So I'm going to go over to the buy sheet and see what they're estimating. So in this scenario, the person who put this together was thinking we were going to be 5.25 million to offer a first loan, basically 75%. 75% loan to value. They've calculated out the closing costs here, land transfer tax, all that stuff. So in the short run, they're saying 1.5 needed, but of course you'll also need the money to cover your first year of negative cash flow too. If you're going in with a transition plan, and you would really need to have a plan with this building. Would you say that's true, Jake? Like if you're coming in, you got to have a
Yeah.
turnover plan. Yeah.
Well, for sure, right? We'll get to the rent roll, but you'll see that
Yeah.
there's a number of extremely low units in here.
Yeah, yeah. So some things to point out here. They've got hydro at 3750. So obviously just electrical. They're not paying water. I don't know how that's possible. How are they not paying water? They're not paying gas. No hot water tank.
Yeah. So
Yeah,
we'd have to verify these numbers,
yeah. There's
right?
some
So I
things
don't
to
like
that.
because I see that and go, well, no, that's impossible, right? These older
Yeah,
buildings, unless they sub-metered the water, but then what about laundry, right? If
yeah,
every unit doesn't have
yeah.
in-house laundry,
So some
where's
questions to ask. Yeah.
yeah, right? So
Yeah, and then so we've always said, if you see a tax number with an odd number, odds are it's probably accurate. That's probably your 2023 final. They got a property manager allowance here at 7%, which on a building that big, I would say it's potentially even possible to get it for less. Like especially if you have an
yeah.
in-house superintendent, because I know we don't typically budget that much, right? We're like 4% for management.
Well, yeah, and I think there's a case here for two separate performance to be run, right? There's the
Yes.
your CMHC underwriting, which is going
And
to
yeah,
be minimum 4.225%,
yeah,
or at what your contract states, for management, right? So
yeah,
we could potentially run this out of 4.25,
yeah.
um, for financing purposes. But realistically, if you're looking to be hands off and live,
Hmm.
downtown Toronto and own this building,
Yeah,
then yeah, I would say you're 5, 6, 7% is the realm you're going to be in.
sure. Well, you've got salaries here at 13,000 in addition to the management. So that's well
Yeah,
padded, I'll say at very least. I mean, that's a well padded $136,000 negative cash flow for the first year. Um, Mortgage is obviously a big expense in here. That's them subbing in what the payments would be on the new 75% loan to value mortgage. So let's get into some of the financials here. This is the rent roll. They have it laid out as financials. They've got for reference here your market vacancy rate, which obviously demand for housing's high, but there's transition between tenants. That's really what drives that. Okay, so in terms of bedrooms, it's a mix of one and twos. And then this is the thing you pointed out to me when we were initially looking at this is the ones that haven't turned, the ones that are at 800, they're obviously not renovated. So what mix
yeah, we don't
of
necessarily know that, but I think you can use common sense here and say, okay, they're
deductive
more
reasoning
than
would
likely.
suggest? Yes.
Yeah,
Deductive reason. So about half the units look like they've been renovated. So in terms of achieving, so you've got your sort of market rent, which I think like it's hard to find places to rent in London. So especially in this neighborhood, it's pretty desirable. I think there might even be potentially higher rents to be had, but it depends on the size of the
yeah,
units, of course.
and
So this is,
building quality is good,
yeah, it's
right?
nice. Yeah, like you got nice chandeliers, like you're going to attract people as long as it's got the functionality there. I couldn't tell, maybe it's in the write up here, but if we've got in-suite laundry, because that's a big thing, especially down there in Mortley, like lots of places don't have it because they're too small.
Yeah.
So that would be one of the things they said. Let's see, meticulously maintained building, 50% of units fully renovated top to bottom, as we've seen.
Yeah.
Um, there's an elevator. Okay, so like it's accessible. There's a lot going for it. Never a vacancy, they say. Um, Healthy passive income. Well, real estate's not
Well,
passive. Let's not
one way
be
you
like
can
that.
one way you can try to look for that, Andrew, as well, is just in the financials itself.
Yeah,
Um,
right. Can we figure out if laundry's in the unit? Yeah, are they
right.
charging for it,
Do you
right?
have
So if we
Yeah,
go
do you have
back
do you have a laundry line?
on the buy, let's see. On the buy, is there a laundry line? Residential rent. Yeah, no. Oh yeah, laundry. Yeah, okay. So
Laundry,
laundry
there you go.
not in unit, that would be the one strike against it. If there was a way,
Yeah.
if I'm ever renovating a unit, if there's a way, I'm putting laundry in that unit. So if it was optional or possible here, I would be doing it on all the other units I turn over. I'd be putting laundry in because then that allows you to, in my opinion, and you probably would agree with this too, Jake, is charge much more on the rent. Like in unit laundry is gonna not only
Yeah,
lubricate applications, it's gonna make people pay more, I think.
for sure, right? And I always look at myself as a, you know, everybody's unique in their own way, but obviously, I like in-suite laundry. I imagine most other people would like in-suite laundry. I've lived in the apartment building with the coin operated laundry in the basement, and so you go
Mhm.
down there sometimes and it's things full and you got to wait.
Mhm.
So
Yeah,
there's a lot of benefit for that in-suite laundry if you can do it. The one negative is obviously if it's common water, now you're going to be paying a lot more water.
yeah.
Um, Everybody's going to be more inclined to do laundry frequently when they have their own machine. So just be cautious of that. But perhaps you can pair that with something like a wise meter program, and start sub metering water.
Yeah. Yeah, and you can sub meter. I've never build it back that way. Like I've sub metered out a unit and then we had to do a paper bill back, which we found very tedious. And then wait and
Yeah.
try and get the tenant to give it to you. It was a real mess. So I'd want to have that properly administered. I'm sure there's companies out there now, and I've heard of this happening, is that they'll fully administer that program. Like they'll
Yeah, no,
bill
so
back.
that's like
Yeah.
that's like wise meter,
Oh,
right?
okay,
So that's a
perfect.
company we've worked with in the past, and it's completely automated,
Yeah.
and they just bill the tenants direct.
Yeah. Okay. So they're saying basically you could come in and you could get, well, this is somebody who has sent this to you, who did this analysis, saying you could come in and you could basically increase these rents. Some of them, like you can just tell they were rented when they were completed. Um, but the other ones that are still low here in the 800s and 900s, those are the ones where you could go in and potentially get the 895. But one of the things we need to know is like how much are you spending per unit to get there, right? Are you another
Yeah,
30,000 a unit? Looks like they were nice renos. So
yeah,
um,
yeah,
one of those ones that could be really worth doing, but I'd be all over trying to find some sort of in-suite solution here, even with the renovated units. If I when I turn them over, I would want to find a way if there is
yeah.
way.
And so
Yeah.
I think the factor here with this building, Andrew, is that you have 50% turnover, 50% not.
Hmm.
I imagine the seller went through and turned over as many as they could possibly turn over, and now they're
Hmm.
stuck with perhaps the elderly tenants or the tenants that just said no,
Yeah.
not moving. You know, um, and so what do you do now? Like, how do you mitigate your risk? Because if you were to buy this, numbers
Yeah.
aside, numbers work, numbers don't work, whatever. But say you were to buy this building now, what do you do? How do you mitigate risk on a building where you potentially might not have a
Hmm.
turnover for another 2, 3, 4 years?
Yeah.
And the cash for keys approach has already been done. Um,
Yeah. You've already
you know,
approached
and,
them, so
and
they've already got a bird in their ear that it's worth, $10,000 potentially. Who knows what was said? That may or may not have been said.
they could
Maybe
have
they
they could
never
have went
offered
to forty
anything.
thousand dollars.
Yeah.
Exactly. So you got
Yeah.
to. I would say that's the first thing you have to do is go in and talk to the sellers and say, hey, did you guys
Yeah.
do cash for keys?
Yeah.
What's the approach here? Um,
Yeah.
and I think again, a way to mitigate risk is obviously through purchase price, but it could also be through, seller financing,
Hmm.
seller rental guarantee. Is something that you can dabble with, where the seller would
Yeah.
actually basically cut you a check saying, "Hey, I'm going to guarantee you a higher rent."
Yeah.
Um, help mitigate some of that negative cash flow for a year or two.
Yeah.
Like you still obviously have to perform. That's the one thing that bothers me is when buyers are like, well, I want to be so protected that I don't have to do anything for 5 years and I'm still going to be fine. It's like, well, no, now that's
Yeah.
on you. If you want to, like,
Yeah.
it's not, again, like you said, it's not passive real estate. Um,
Yeah. So it would more be if you don't get X number of turnover in the next 5 years, the seller's committing to something, or like you said, like it's anything you can
Whatever. Yeah.
negotiate. I've given rental guarantees on stuff I've sold.
Yep.
When I've done turnkey stuff, like it's just positioning it to the buyer that hey, we're doing it as turnkey as you can, knowing full well that real estate's never fully passive. Like you're gonna have to be involved to some degree, but
And that's it.
you can
And
minimize it.
that's it. So, yeah. And
Yeah.
so you mitigate your risk, do as much as you can possibly do to get that building turned over.
Mm.
Reduce the expenses, try the wise meter, try this, try that. Like there's a million things you can do.
Yeah.
It's all about increasing revenue, dropping expenses. That's at
Yeah.
the end of the day, right? So
Just
that's
gonna
my
share
thoughts on
this.
it.
Just going to
Yeah, go
share
for
this.
it.
So this is what they are suggesting. So the person who put this analysis together is suggesting it might be possible if you did stabilize it. Obviously, getting a value higher and then getting 73%. I'm guessing that's based on their debt service. But this is going to be assuming a huge amount of the units are turned over. So they're linking back to the financials. I just want to take a look. Are they assuming that everything gets turned over or just some?
Yeah, I think they assumed that all units were turned over there.
48. So let's see. Yeah, they're just taking the higher number, I think. Yeah. Yeah, 48 here. So it's either of these. So yeah, so that's
Yep.
obviously G48. Just want to make sure I got that right. G48. Yeah, that's the fully stabilized up increased rent. So it's not, and this is the challenge with the financial analysis is because nothing ever works out this cleanly. Like
Correct.
you have two moments in time, the moment where we're 50-50 on turnover units, and then the moment where we're 100% complete. Like
Yeah.
those two moments could be
And this is
separated by
why
10 years.
Yeah, and this is actually why, Andrew, our internal team right now, we're working on a 5 year projection.
Yeah.
So it'd actually be a pretty much a pro forma for every year for 5 years, showing that hey,
Yeah.
natural turnover in the area
Natural.
is X amount, and
Hmm.
it'll show you that your expenses are going to increase. Because here's the challenge, right? Like
Hmm.
there's taxes are going up all across Ontario.
Property
That's
taxes,
inevitable.
right?
Like
Yeah.
we're reassessing everything right now. So you know if you don't get a single turnover for 3 years and your property tax goes up every year, it's going to put you in a really tough
Hmm.
spot. Um, And so these are the things to keep in mind. And this is why we want to start showing our clients a 5-year projection at the minimum is a
Yeah.
5 year. To say, here's what roughly it would operate as year over
Mhm.
year. And then in a 5-year term, we're hoping that you have the rest of
Yeah.
those 50% turned over and we can move, stabilize and move forward.
Yeah, I'm curious, like from the audience, just people watching this, if you've got a spreadsheet analysis format you like for these deals, because we've got the one Jake built and likes to use. We've got this one that we showed today, which is obviously we're still not showing that in between, and then you're obviously building something out. We've talked about
Yeah.
this. We want to create something that we can actually give away that people can use as a tool and run their own
Yeah, and
numbers.
there's a fine line between, like, we have internal documents that have 15 tabs, right? And
Yeah,
it's
that's too
like
much. Yeah,
it's
it's too
really, really
complicated.
detailed. Yeah, you don't want to do that for every building. Like, that is, hey, I've tied this up conditional. I am
Yeah.
buying it. I've invested in it. Great. I will take the time to go through and build out a full projection of what this is going to end up looking like. But when you're just on MLS wanting a quick analysis, yeah, a one pager is totally fine to say, hey, what's it look like?
Yeah, so some
How
sort
is
of
it? How
quick.
is it now? How is it on
Yeah.
complete? Right.
Well, and that's where I
So
like to build in the shortcuts. Like, what are my shortcuts in an analysis that allow me to quickly assess something and decide if I like it enough to proceed further? That's
right.
really what it is, right? So, okay, very cool. Yeah, we're gonna be putting something together. So, people have comments on that, or if there's something specifically in terms of functionality you're looking for, write something to us in the comments, or feel free to reach
Yeah.
out to us. And yeah, we'll see what we can create. But anyways, Jake,
Love it.
thanks for doing this. Any parting words of wisdom before we wrap up for the day?
No, I'm excited to see those comments, Andrew. And once we get this all ironed out, and we'll basically have a live link for people to access our performa.
Mhm.
Would love to see how your deals are looking. Send them back. Let's have some communication. Um, there's good deals out there right now. MLS, off MLS, everything.
Mhm.
If you know, if you have one you want us to review, let us know. If you're looking for one or you're looking to sell your building, go to the link below. As always, reach
Yeah.
out and we'll be in touch. We're working with five potential buyers right now that have come through this this YouTube series,
Yeah.
and it's fantastic. So they've come in, they've educated themselves on our episodes, and now they're in a spot where they're looking to purchase and utilize the skills that we talk about all the time.
That's actually really cool to see that, like, come around full circle because the show.
Yeah,
The one thing I really like about this is like how much people have an opportunity to get to know you and your process, and like it's not like they're surprised when they talk to you. Like you talk about this stuff all the
yeah,
time. So yeah, it's good. It's a good way of doing things. Glad we did this. Anyways,
right
okay,
on.
Jake, thanks for
Okay,
this. Talk to you next week.
have a good day, Andrew.